Welcome to another Taxes in Retirement Live. I am Andy Panko, owner of Tenon Financial. Thank you for joining me. Tonight's topic will be asset location. You all have probably heard of asset allocation, which I'll touch on, but tonight is asset location. Before we get started, let me hit you with the disclaimer. This video is only general explanations and education. It is not specific tax, legal, investment advice. Before considering acting on anything you see in this video, first consult with your tax, legal, or investment advisor, which I am not. I'm just some guy on Facebook giving out helpful hints and education about the fun and exciting world of tax-efficient retirement planning. Yay. Dad jokes for tonight. I will start you with, there was a river that ran through Egypt that no one believed existed. Locally, it was known as Nile. It ain't even there. It's not there. My best friend's wife ended up giving birth to their son in the car. He named the kid Carson, as in Carson. Quick side note, I used to watch, or still do watch, like strongman competitions when they're on, and oftentimes it's Swedish or other Nordic country folks, and their last names are often as simple as like Samuel's son means son of Samuel. So people have, last name is really just sort of parents' first name, and then whether or not you're your son or daughter. Like in Iceland, it's often something daughter, like Samuel daughter will be the last name as in Samuel's daughter. Anyway, fun fact. And finally, my daughter used to swallow coins all the time as a kid. I have definitely seen some change in her. 37 cents, handful of dimes, nickels, whatever. Okay. So yeah, thank you. So tonight again is asset location. Now, I should preface this by saying that some of this is somewhat subjective. There's sound, fundamental logic and rationale behind why I'm going to present the things I'm going to present, but depending where you look, who you ask, you'll definitely see slightly different takes and sort of guidance on what the optimal location is. So what is asset location? Basically, it's which asset types, stocks or bonds or real estate or whatever, should ideally be in which account types, of which there's basically three. There's regular taxable brokerage, there's Roth accounts where you're taxed on the way in, but not on the way out. And then traditional tax deferred accounts, which is the opposite. You're typically not taxed on the way in, or you get a deduction on the way in, but then you're taxed on the way out. And then you can sort of throw HSAs into the mix as well. They're kind of a combination, best of both worlds, of Roth and traditional, in that you get a tax deduction on the way in and tax-free on the way out. But we'll leave that out for now. But for the most part, you can kind of lump that in with Roths for purposes of tonight's discussion. Consider the benefits and location preference of Roths kind of the same as HSAs, or vice versa. HSA is the same as that of Roths. And the other thing I want to say is that don't get too hung up on this. So asset allocation, how much of your total portfolio should be stocks versus bonds versus cash versus whatever, that's the much more important thing to get right. So for example, if you're 25, you have decades worth of working and saving, your longer term money, your 401k, the stuff you're not going to touch for 30, 40 years should almost inevitably be all stock or close to it, just because there's so much time on your side for growth. You don't want it sitting in cash or super low earning, very safe bond funds that aren't going to do much. Like, yeah, you're not going to lose much, if anything, but you're not going to make much either. Over the course of decades, the higher growth assets should do better. So that's asset allocation, making sure your mix of stocks versus bonds versus cash is right overall. And that's very important to get right. And then for retirees, it's kind of the opposite. You don't want too much in stocks or riskier stuff. Now, that all depends on your situation. There are cases where I can make a very defensible argument that even in retirement, someone could or should have the vast majority of their wealth, of their investable assets in stocks. We could touch on that later for the questions. And feel free to post comments and stuff in the chat here. I'm going to run through my thing and then take questions at the end. So just to try to not break up the flow too much. So get your asset allocation right. That's most important. Next, this asset location is really just a way to hopefully squeeze out a little more value, a little more net income, net money from your investments by way of tax efficiency. And we'll discuss this as we go through, but certain asset types are better suited to be in certain account types from a tax efficiency perspective. So getting your allocation right is the first and most important thing. And then this is sort of like a second level, bit of a tweak to add a little more benefit to the process. So with that said, don't get too hung up on trying to, get your asset location dead on per what we're about to discuss. Sometimes it's not possible just because you don't have the amounts to move around, or it's in a taxable account where you can't easily sell stuff and move it without triggering tax events, which you may not want to do. So allocation is most important. Get that right. Location, nice to have. Tweak it, optimize it if you can, but don't lose sleep if you can't nail down exactly to the schematic we're going to discuss tonight. Plus, again, keep in mind, some of this is somewhat subjective and depends who you ask. And I'll explain my rationale, at least for why I'm discussing what I'm discussing. All right, so I got some nice slides for you. Hold on a second here. Let me get a drink first. Alrighty, here I am. I'm back. So I will now go to screen share and bring this up for you. Share screen. Getting there. Here we go. Okay. So let me just start again. What is asset allocation? This is just, picture this big pie, this big circle, your total portfolio of investable assets. This is just a very basic, typical 60% stock to 40% bond. I include cash in the bond portion, so consider that gray, bonds and cash. But anyway, so this is 60-40. So let's say you have a handful of accounts on an aggregated basis. Your asset allocation is 60% stocks to 40% bonds and cash. This is what it looks like. Get that right for whatever's right for you. That's a different. What is your right allocation? That's a whole different topic. There's various things that go into that decision, and everyone's going to be slightly different. Part of it's your own personal and emotional views towards risk. It's not all just a dollars and cents analysis. Some of it is, do you lose sleep if you take on too much risk? If that's the case, and that's going to impact your decision. Other people are risk takers to the point they're almost gamblers at heart, in which case they're going to have higher allocations to risky assets. But point is, this is your overall portfolio. Let's assume it's 60-40 like this. What if you what I was looking for. All right, that's not cool. Where my other slides go? Good. Just give me a second here. This wasn't the version I thought I had saved. I cut out a lot of good stuff along the way. Okay, let me pull up a different slide for you. Financial asset location. Just give me a second here. Just looking at my other files here. I had mistakenly cut out a bunch of stuff from that slide I didn't want to take out. Okay, I'll do this. All right, so let me just change my screen share for a second. Go back in here. Sorry for the hassle. Okay. Let me just clean this up so you don't see all this nonsense. Reading view. All right. This is going to be a lot repetitive because I use this for something else. So there's a lot more granularity to these slides there needs to be. But so that's your overall asset allocation. What if you have 3 different account types? You have a regular taxable brokerage account on the left. You have a Roth account, Roth IRA, let's say. And then you have a traditional tax deferred account, like a regular traditional IRA. So in your overall 60-40 allocation, sure, you can take each of your different accounts and make them each, equally 60-40. It doesn't matter how large or small all these accounts are in total dollar size. If you make each one 60-40, guess what? Your total portfolio, when you add them all together, is going to be 60-40. And many of the larger investment firms, the names you all heard of, I won't mention names here to speak bad of any firm, but the big national names that you've seen commercials for, that you undoubtedly have known people who work at them. Oftentimes, regardless how many accounts or what account types you have with them, you get the same allocation across all your accounts. They'll run you through a risk tolerance questionnaire. They'll look at your financial circumstances and say, okay, you should be 60-40 as a whole. And you have 3 accounts with us: a regular brokerage, a Roth IRA, a traditional IRA. Guess what? We run all your investments through this automated model that picks 24 different mutual funds in a 60-40 allocation. You're going to get many times, not always, but many times, you'll get the exact same allocation across your 3 different account types, just because it's easy for them to implement that way. But that's not necessarily best. Like, yes, this can work. And again, like I said, the most important thing is get your allocation right, which it is. So good. Kudos to you for that. And kudos to whoever's setting up your portfolios here. But what if you can make things that much better by playing a little bit of tax efficiency into it? For example, so this was each account is 60-40 stocks to bonds. What if instead you stacked more stocks into your taxable brokerage account? So now your taxable regular account is 80-20 stocks to bonds. Maybe you keep your Roth at 60-40, and your tax deferred account is only, 20-80, I guess, stocks to bonds. Now, when you blend these all together, I don't have dollar amounts here, but so you can't proof the math, but just assume when you blend these all together back up into one big fat portfolio, you still get to 60-40. The difference is you're choosing different accounts that have different allocation, different asset types. That's asset location right here, right? You notice they're not the same 60-40 allocation across the 3. Okay, now let's get into, again, my take on what the ideal account location type is, or account type is for each asset type. And this isn't science, like I said. Some of you will have different views and opinions, and they can very well be defensible and right. There's not necessarily a single right answer to this. And some of my rationale is that, yeah, it's not necessarily, this asset type isn't necessarily bad in this account type, but there's other assets that are better in that account type. So save that account type, save its investable capacity for the assets that are better, and put the other assets somewhere else where they're better suited. So it doesn't necessarily mean the assets are bad in there, certain types. It's just that they'd be better elsewhere. So I'm going to call them like not so great in this particular type. So here's my color coding for this. When you see a red frowny face, that means try to avoid it. And I don't want to say, I never want to say absolutely do not put this asset type in this account, because sometimes you have an option. Like, let's assume you only have one account and it's a regular brokerage account. Well, guess what? None of this really matters what we're talking about tonight, right? You don't have a choice. You may not have a choice what account type you put your assets in. So that's going to be a big limiting factor as well. Or maybe 99% of your assets, of your investable assets, are in a regular brokerage account, and only $1,000 is in a Roth IRA or something. You may not be able to stack your whole allocation, ideally into your Roth, because your Roth is so small relative to the rest of it. So there are going to be constraining factors. Keep that all in mind. And again, don't lose sleep. If you see a red frowny face on something, you're like, oh no, that's where mine is. It's probably not that bad. Anyway, so the red is try to avoid it. The yellow meh face is like, yeah, good enough. Not horrible, not great, but it'll do. And then the green smiley face, obviously that's kind of ideal, or at least my opinion of that would be at the ideal place to keep this asset type. So let's start with the asset type of bonds, specifically those issued by federal government and corporations, so government and corporate bonds. I'm saying try to avoid having them in a regular taxable brokerage account. Why is that? Because a large part of the total return from government and corporate bonds comes from the interest they throw off. And interest is all regular taxable income. There's no reduced long-term capital gains rates or anything. It's all taxes, ordinary income. So when you have it in a regular brokerage account, all that interest that gets generated throughout the year, or gets paid to you throughout the year, is all taxable that year. And you have no control over it. It's all going to be ordinary income tax. So for that reason, not ideal to have bonds in a regular taxable brokerage account. How about in a Roth account? Now, honestly, I don't think there's anything really bad to put in a Roth, But this is one of those examples where I'm saying it's it's good enough because although it's not bad, there's other things that are much better suited for a Roth. So I'm saying because if possible, keep your bonds out of the Roth just to save that space and that capacity for the other investment types that we'll talk about. But again, it's not bad. Don't let this ruin your don't let this make you feel like, oh man, my future's ruined because of this. No, far from it. Again, this whole asset location is just a real nice to have, and it's an extra tweak. It's an extra net benefit on top of proper allocation. So again, I just want to really drive home, like, this isn't a black and white exact science. Like, you have to have this asset type and this account type. And then finally, government corporate bonds, in my view, are best suited in a tax deferred account like a traditional IRA or traditional 401k or 403b or something. Why is that? Well, just for the opposite reason, or sort of the inverse of why I'm saying they're not great to have in regular brokerage accounts, because they throw off interest income, and that would otherwise be taxed in the year you receive it at your ordinary income tax rates. When it's inside a tax deferred account, you don't pay tax on it now. It just sits there and builds, and you pay tax on the future, and it sort of compounds along the way. So that's why I'm saying these bonds are ideal to be in tax deferred accounts if possible, if you can control it and you have the capacity in those accounts. Next, bonds of the municipal persuasion. So these are bonds issued by state and local governments. They are sort of the flip side. The unique benefit of municipal bonds is that in almost all cases, the interest that they pay is not, and this is all just federal, I should mention. I'm not talking about state taxes. Different states may have slightly different treatment of this stuff. This is just federal taxes, tonight's discussion. So at the federal level, interest from almost all municipal bonds is tax-free. You receive it, it hits your account, not taxable. For that reason, this is the flip side of interest from non-municipal bonds, i.e. government corporate bonds. Whereas this interest is taxable, this interest is not for municipal bonds. Therefore, it's good to hold that in regular taxable brokerage accounts. And then the flip side is it's not good to hold it in tax-deferred accounts like IRAs or Roth or 401ks. Because if you hold it in a regular brokerage account, this interest is all tax-free. Once you now put this municipal bond into a tax-deferred account, guess what? All money, every penny, every dollar that comes out of a traditional tax-deferred account is going to be taxable. So if you now have municipal bond throwing off interest payments inside your traditional IRA, it's not taxable in the year you get it, but when you take it out, that's all eventually taxable as ordinary income. So this is not ideal, because this interest that would otherwise be tax-free in a regular brokerage account, you're now making it fully taxable by holding this municipal bond in your tax-deferred account. And then Roth, I'm saying, just for the same reason as this bond. It's not necessarily bad to have municipal bonds in a Roth IRA. There's just other things that are better to be in a Roth IRA. So save the capacity in your Roth for other stuff that aren't these two bonds. Okay, next. Equities, low turnover. So what do I mean? So equities is just a fancy word for common stock, regular stock. Low turnover means shares you do not frequently buy and sell. You buy it, you hold it, ideally for at least a year. Why a year? I touched on before the concept of long-term capital gains. So in tax speak, capital gain is just simply when you buy something and then later sell it. Any gain you have in the time you held it is called a capital gain. If you held that something more than 12 months, it's called a long-term capital gain. If you held it 12 months or less, it's a short-term capital gain. Why does that matter? Because long-term capital gains are taxed at tax rates that are lower than ordinary income tax rates. It's either 0, 15, or 20% are the long-term capital gains rates, whereas your ordinary income tax rates go all the way up to 37% currently. So if you're going to own stock, equities, and you plan on holding it at least a year, it would be ideal to hold it in either a regular taxable brokerage account or a Roth account. And here's why. In a regular taxable brokerage account, the gain, when you eventually sell it over a year from now, because it's low turnover, you're not trading in and out of it frequently, When you eventually sell it, all the gain, if any, will be taxed at the reduced long-term capital gain tax rate. Yay. And conversely, you even get some benefit from a loss. If you sell it at a loss, that loss can help offset other gains you have from selling other positions. And if you don't have any other gains, some of that loss, up to $3,000, can be used to reduce your other forms of taxable income, like wages, like bank interest, like IRA distributions, whatever. So you get some benefit actually from selling something at a loss in a regular taxable brokerage account. Therefore, equities that you hold more than a year, i.e. low turnover, are really well suited to be held in regular taxable brokerage accounts and Roths as well. Why is that? So keep in mind that Roths grow tax-free and the money comes out tax-free, assuming it's a qualified distribution, which is you hold it, you're over 59 and a half, and you had a Roth for more than 5 years. It's a whole separate topic, what makes it qualified. But for the most, let's assume all your distributions from your Roth are going to be tax and penalty free. So you want things like equities or stocks that over the long term should grow a lot, especially relative to bonds, which aren't going to grow nearly as much, typically speaking. You would want and like those higher growth assets to be in this tax-free Roth environment. So all that growth happens tax-free, and when you take it all out, it's tax-free. That's why equities, things that can grow a lot over the long term, are well suited to be in a Roth. And then tax deferred account, not horrible, but not ideal. I say good enough, but ideally you'd rather have it in regular brokerage or Roth. And just for the, kind of the opposite reasons of why it's good here is why it's not great, why it's not ideal here. So the long-term gains, if you hold it in a regular brokerage account, like I said, and you sell it, that gain is taxed at a lower tax rate. Any gains in an IRA eventually come out at your regular ordinary income tax rates at the time. So right there, you're losing some tax, or you're losing some take-home money because you're paying more tax, in essence, by having your equities in a traditional tax-deferred account. And same thing with Roth, right? If all that growth is happening tax-free inside your Roth, that's awesome. You can take it out 10 years, 20 years, 30 years down the road without paying tax on it. Well, if all that growth happens in a tax-deferred account like an IRA, well, that's all going to be taxable, all that growth. So if you can avoid it, put your equities in these two types of accounts. Next, equities that are high turnover. And what's high turnover? That just simply means you hold it for less than a year. You bought it today, you sell it in 2 months, 3 months, 5 months, whatever, less than a year. Kind of the inverse, the flip side. So any gains you have, and I thought about, this is red face, maybe too negative on this. Maybe you can call this good enough with that face. So high turnover, if you buy something, you sell it at a gain a month later, that gain is going to be taxed as ordinary income. That's why I'm saying not ideal here, right? Because it's going to be taxed as ordinary income. But the benefit, if you have a loss, just like stocks, low turnover stocks, a loss is a loss. If you have a loss in a regular taxable brokerage account, that loss can offset other gains or offset some of your other income. So after thinking about it, I don't know that this should really be a red frowny face. This should be a yellow flatline mouth face. Maybe better, maybe more accurate. Depends. Different people have different views again. And in a Roth, again, really kind of anything's good in a Roth. There's really nothing bad in a Roth. So equities, all forms of equities, are things that are higher long-term growth potential, I'm saying are ideal to be in a Roth, because all that, that big growth over time will eventually come out tax-free. So, equities you buy and sell frequently are no different. And there's some questions in the group today, and often for that matter, if I have dividends paying in a Roth account, do I pay tax on it? Am I allowed to buy and sell stock in a Roth account, or will there be tax? No. Anything that happens inside the Roth world, there's no tax implications from that trading activity. Whether you buy, you sell, you get interest, you get dividends, doesn't matter. You're only taxed potentially when you take the money out, if you don't meet the conditions for a qualified distribution. And same general concept with a tax deferred account like an IRA. You can buy and sell all day long in there. There's no direct tax implications of doing that. You're only taxed when you take the money out. It doesn't matter what happened inside the account along the way. You're just simply taxed every dollar that comes out as ordinary income. And so these high turnover equities, the ones you buy and sell frequently inside of a year, just like the other forms of equity, I'm saying it's good enough to have in a tax deferred account. You ideally don't want lots of growth happening in your tax deferred accounts. You'd rather have it in a Roth. But again, if you don't have a choice, like if 99% of your investable assets are in a tax deferred account, well, guess what? You're going to have equities in there because you got nowhere else to put them. So again, don't let this make you freak out or think you're blowing up your future or anything. Next, equities that pay a lot of dividends. I'm just generically calling it high dividends. So ideal to be in a regular taxable brokerage account, just like especially if you hold it more than a year, because now your equity is going to be a low turnover, meaning its eventual gain on the sale will be taxed at the reduced long-term capital gain tax rates. And if it's paying dividends, more often than not, those dividends are going to be quote unquote qualified, which means those dividends are also taxed at the reduced long-term capital gain tax rates of 0, 15, or 20%, as opposed to being taxed as ordinary income. So double benefit there. Roth, again, there's really nothing bad in a Roth, and equities in particular are the right things to have in Roth accounts. And then tax deferred, kind of same reasons as before, right? Equities compared to bonds are more likely to have more growth over the long term. You ideally want the higher growth stuff in a tax-free account like a Roth, as opposed to a fully taxable account like a traditional IRA. And then the next one I decided to include is Reits, a real estate investment trust. Now, this chart here, as you can see, isn't the entire investable universe of asset types. It's just the most common that I brought up, but there are going to be some other things out here that don't neatly fit into any of these buckets, these 6 buckets I have here. So real estate investment trust, on the surface, it kind of looks and smells like a stock. Like you can buy it through a brokerage account like it's a stock, but structurally it's very different. It's its own legal and tax classification of how it's set up, what it has to do. It has to own the majority of its things that it owns or investments. It needs to be real estate or real estate related things like physical buildings or real estate or mortgage-backed securities or other real estate related securities. It also needs to pass through, I think 90+% of all of its income needs to get passed through to the shareholders in the form of a dividend. Now, REITs, the taxation of dividends on REITs isn't as generous or as good as the taxation of dividends on normal stocks, normal common stocks. Because like I said, most dividends on most stocks are going to be quote unquote qualified, which means they're taxed at reduced rates. REIT dividends cannot be qualified. They're not eligible. So by default, they're taxed at ordinary income tax rates. But there is a bit of, currently, there's a bit of a little benefit, not to get too technical with taxi stuff, but there's something called the qualified business interest deduction, where, long story short, up to 20, you can get a deduction, tax deduction for up to 20% of your REIT dividends. So even though the dividends themselves are taxed as ordinary income, you can sort of on the back end get a bit of a deduction against those, such that your effective tax rate on those dividends comes down a little bit. So for that reason, I'm saying, and also dividends aside, REITs are kind of like stocks in that, long term they should hopefully grow in their price should increase ideally, more so compared to bonds. Therefore, it's a longer term, higher growth asset. So it would usually be pretty good in a taxable brokerage account, because if you hold it more than a year, you can get the reduced long-term capital gains tax rate when you sell it at a gain. The reason why I'm giving it a good enough face is because of the dividend treatment. Like I said, dividends are taxed as ordinary income as opposed to qualified dividends. They're taxed at lower rates, but you get a bit of a tax deduction because of the qualified business interest thing that I talked about. So good enough in here. And again, there's really, you can't go wrong putting anything in a Roth. So ideal in a Roth. and then good enough in a tax deferred account, just like the other forms of stock / equity. I'm calling it all good enough. So that's it. And if you invest in funds, mutual funds, it's all more or less the same story. Like I'm talking, this chart is individual specific securities, like a government bond, right? Or a corporate bond, or a municipal bond, or a single stock. The gist is the same for the most part, whether you own these securities individually, stock A, stock B, stock C, or you own a mutual fund or an ETF that owns thousands of underlying stocks or bonds in it. The basic location, preference, and treatment is more or less the same. There could be some tweaks to it. I'd have to think about that, but maybe like mutual funds that have capital gain distributions throughout the year. You own an actively managed stock mutual fund. The fund managers are going to be buying and selling stocks within the fund throughout the year. And at the end of the year, they have to pass through to you, the fund holder, your share of any capital gains they had during the year. So you have no control over those capital gains. You just kind of get them handed to you at the end of the year, and they're going to be taxable to you. So in that sense, high turnover, actively managed equity mutual funds, I guess this sort of works as well. Not ideal. Try to avoid if you can in a regular taxable brokerage account. Better suited elsewhere. Is that it for my slides? Yes, that's for my slides. Okay, so I'll leave this up in case anyone has any questions on it. Let me think if I have any final comments. No, I guess I'll leave it there for now. Okay, so relatively short. That was only a half hour's worth of me doing my thing. I will go to questions now. I'll leave this up, like I said, just to see in case I have to come back and reference this. Oh, and just one other sort of live story, anecdotal story about how it's hard. Don't get too hung up on trying to make this absolutely perfect. So, some of the clients I work with, they have money in 401ks or their employer plan still. I don't directly manage that for them. That's their employer. I'm not allowed to log in and do trading for them. It's on them to do the trading if and when they choose to. What I manage is the accounts they have under my management at TD Ameritrade. So I can freely go in and rebalance and reallocate and move this stuff around in their accounts at TD, except for the taxable brokerage account. There you have to, like I said before, you have to be cognizant of, you don't want to just go willy-nilly buy and sell stuff, because when you sell, you may trigger off tax, taxable gains and stuff like that you have to be careful about. So you can't too freely reallocate stuff all the time in a regular brokerage account, but Roth IRAs and IRAs, yeah, you can easily allocate whenever, because there's no tax implications to trading. So anyway, my point is, in the clients I work with, while I don't directly manage or oversee their 401ks, I'll at least look at how they're invested, what their options are, whatever, and factor that into their broader portfolio allocation. And I just had someone I was working with a week ago, had this 2 weeks ago, maybe, had this discussion where, okay, the accounts at TD, that they're only sized, there's only so many dollars in them. The 401k is pretty large, so there's only so much location I can control with the accounts at TD. If you want to further control and stack this stuff as it's lined up in this chart here, you're going to have to go and do some rebalancing of your 401. Now, I'm happy to make the recommendation of, okay, go and move 200 grand from stocks to bonds, whatever. But guess what? We do a rebalance. I do a rebalance every quarter. So every quarter, I'm gonna have to call you up and be like, hey, here's the instructions. Go ahead and do some trading in your 401. It's gonna be clunky and cumbersome. Now, some people don't mind, right? They may not care. Some people enjoy doing all this stuff, but otherwise, it could be a hassle to sort of really fine tune to nail all this stuff down precisely, because you're gonna have to trade across multiple accounts. If a lot of your money's in an employer plan, like this situation I'm discussing, it may not be feasible to do, or your plan may put restrictions on how frequently you can trade in and out of stuff. So that can really, restrict your ability to go and move all this stuff around to try to optimize the location. So again, don't get too hung up on having to feel like you need to get your location exactly aligned with this here, because it may not be feasible. Or at least it's more work than it's kind of practically worth. Okay, so that's all I got. I'm done for now, I swear. Let me get a drink and I will see what kind of questions we have. I may actually try to look at the post in the group and see if it's easier for me to see see comments there. That may make sense. Okay. Yes. Okay. So I don't see, unless I'm missing it, I don't think I see a lot of questions. Comments. Let me go back to my streaming. Okay, so if anyone has questions, feel free to throw them in now. It doesn't even need to be about tonight's topic. I'm happy to take whatever you're looking to discuss. Okay, so question from David Foltz. Do low current interest rates change the asset location optimization equation? Just trying to think what I think you mean by that. Sort of not. I guess I know where you're going with this. So you're saying if there's less interest getting thrown off by this stuff, then there's less of this. Let me go back. There's less of this interest getting taxed as regular income, so therefore maybe less of an issue. And yeah, to some extent, I'd say that's true. The bigger problem is bonds simply aren't doing a lot with interest rates so painfully low. You're not going to get more than a few percent, sub 5% interest on your bonds, unless you really start going down the credit risk spectrum, or going up, I should say, the credit risk spectrum to some dicier issuers and lenders, such that you start to run some risk of there being a default potentially. If you're investing in U.S. Treasuries or you're investing in high quality corporate bonds, you're not going to get more than maybe 2% interest on your bonds. The other thing you have to watch out for is the interest is only one part of your total return. The other part is the bond price, where you buy it versus where you sell it. Now, if you buy single bonds and you buy a bond and hold to maturity, then this price change concept doesn't matter. But if you own bond funds, it matters. Or if you own individual bonds and sell them before maturity, it matters. As interest rates decline, bond prices rise, and vice versa. Well, guess what? We are near historic low interest rates. We were at lows a year ago at the peak of the crisis. Now, as the economy is recovering, interest rates are starting to come up. There's potentially inflation on the horizon. Interest rates are starting to rise. That means bond prices are going to come down, which is not good. So that's going to hurt the price of bonds and bond funds. Which isn't good because they were already throwing off small interest to start with. And now, coupled with that, they may lose a few percent in price. And guess what? Your bond funds are maybe flat at best for the year. They're probably more likely down a few percent. So not ideal. So what do you do? Where can you go to get some safe, stable yield? There's not a lot of options. Savings accounts pay 0.5%. The upside there is there's zero risk of loss, in a traditional bank account. But the interest is jokingly small. So bonds, you're really not buying bonds for yield or for any sort of meaningful return. Bonds are really just kind of there as an anchor of stability, relative stability, especially compared to the stock portion of your portfolio that's going to do crazy things along the way, but long-term should ideally and hopefully go up. Bonds just kind of like chug along. Now, last year, most bond funds actually did really well because interest rates dropped so much from the beginning of the year. Because of the crisis, pandemic, rates dropped. So bond prices did really well, most of them. So, the bond funds I use did uncharacteristically well last year, which was nice to see. But this year, not so much. This year, the fund's down a few percent. But that's there's really not a great solution to what to do for the safer, stabler part of your money. Now, there's some alternatives like investing some of your money in insurance products that can produce slightly higher yields, few percent, maybe 3, 4, 5%, depending what the product it is, but you're locking it up longer term. Almost all forms of insurance products, whether it's annuities or, dare I say, cash value life insurance, that shouldn't be used first and foremost as an investment, but nonetheless, it has a secondary feature of an investment-like function to it. With insurance products, the price you pay for the higher interest that they give you is you have to commit your money or some of your money for a certain amount of time. So depending when you need your money and your access to it, the insurance-based solutions may not be the right fit for you. So there's not a lot of great options, defaults for what to do with bonds at this point. But anyway, long-winded way of saying the low interest rates don't dramatically change this matrix, in my opinion at least, of what should be held and where. But good question. Okay, I see. Who was it? Someone said put up a question. Alan Thomas. Let me scroll up, find your question. Here we go. Do you think the government TSP F and G funds are a good place to hold bonds? Most of my retirement funds will be in TSP. So for the folks at home, TSP stands for Thrift Savings Plan. It is the federal employee equivalent of a 401k, and it has 5 or 6 funds available to participants. The F fund stands for fixed income. It basically is nothing more than an index fund that invests in, I think it's the Bloomberg Barclays Aggregate Bond Index, which is a mix of U.S. Treasuries and corporate bonds. And the G fund stands for government bond that invests in it's its own special collection of investments, but essentially it's kind of like a stable value fund that invests in or pays you interests roughly equal to the yield of the 10-year Treasury, which I think now is bumping up close to 2%, maybe. I haven't looked in a while, but high 1 point something percent. So are they a good place to hold bonds? Most of your retirement funds will be in the TSP. I mean, yes, those are bonds by definition. TSP is a bond fund, Alan. That is the bond fund in the TSP. The G fund, while it is in bonds, I view that less of a traditional bond fund and more of a stable value fund, because I don't think the G fund has any risk of loss. It only has this interest, whatever it is currently, close to 2%. I don't know. It's only this positive return every year, whereas the F fund can go down in value. The G fund cannot. So yes, the F fund is the place to hold bonds because that is a bond fund. The G fund I view more as a cash equivalent. Because there is no risk of loss, and the kicker is you get higher interest than a regular savings account. Like I said, it's probably somewhere between 1.5–2% now, I think, in the G fund. But yes, good question. So, and if most of your money, Alan, is in the tax deferred portion of the TSP as opposed to Roth, there you go. Looking at this chart, bonds, government and corporate, good to hold in tax deferred account. If most of your money in TSP is tax deferred, boom, F fund is your answer. This is not specific advice to you. Just let me caveat that. Just saying in general, your question lines up well with this. And yes, F is the bond fund in the TSP. So good question. Okay, what else do we have? All right, so let me just scroll. I see there's a handful of random questions, one about NUA and stuff. I'll get to that. Let me just go back up top and see if there were any other questions related to tonight's topic, and then I will get back to the random mixed bag of things that came in. Yeah, what do we got? So maybe use a 1 to 5 rating instead of the faces for the, yeah, a good idea. I wanted to color code it, so let me just put this up. Nope, that's not it. Recommendation, maybe use ratings, numerical ratings instead of the little smiley faces, frown faces, and meh face. I did this just because I wanted to keep it as simple as possible. I wanted, good, bad, and different, basically, and I wanted to color code them. But yeah, I noticed that the color, especially the yellow and the green, not perfect. And for people who are colorblind, I really apologize. I didn't even think about that. You probably, may not be able to see any of this except maybe the yellow. Here's a good one. Would REITs be considered similar to corporate and government bonds? No. So in some stretch of an argument, yes, because typically REITs, not all of them, but if structured well, if they perform well, they can throw off pretty respectable dividends. In which case you can sort of view that as like a stream of interest payments from a bond. So in that sense, yeah, maybe. But where it's really different is that REITs, the principal value, the notional value is much more like equity than a bond. It can go up a lot, it can go down a lot. Whereas bonds, for the most part, unless it's really risky bonds that can, default to come crashing down, bond prices kind of like they just sort of chug along, especially if it's a shorter or intermediate term maturities. The price just kind of like, bumbles around a range bound. For reasons that's outside the scope of this, I mean, I might do a video at one point about bonds and bond math. That's going to be real nerdy, but for those who are interested, we can dig into why bonds are very different, why they're much more formulaic than stocks, and how there's a lot more math driving what bonds do and why, as opposed to stocks. And bonds are much more rational, which is why I like them. Stocks are completely irrational. Sorry, I'm getting off on a tangent, but no, I would not consider REITs similar to corporates or government bonds. They're stocks. They're much more like stocks, but often with a higher and or more stable dividend, I would say. Okay. Is this a question here? It looks like a question. In my 401k, I have both tax deferred and Roth monies. I have tried to make my Roth portion all stock and my tax deferred bonds. Okay, in line with what we discussed tonight. However, my holding company doesn't recognize these as separate accounts. Ooh, yeah. And therefore, I cannot invest more aggressively in the Roth like I want to. Is this normal for a 401k type of account? Yes. And hold that thought. Mavis, I think you had the same type of thing. Not a question, but an observation / wish. I wish my employer's 401k plan allowed different investment allocations in the different buckets, traditional versus Roth versus after tax. Yeah, they don't. Now, I'm not certain of this, but I'm fairly confident in saying all 401ks are like this, in that they don't allow you to distinguish these investments are just for Roth, these are just for tax deferred. And here's why. Because 401ks are really just one account. This is a little out there, but it's just, you open up a 401k at your employer, you just have an account, one account. The fact that you have some money that's tax deferred and some that's Roth, those aren't really different accounts. They're just different internal accounting, internal record keeping by your 401k administrator of how much is considered Roth versus how much is tax deferred, but it's all one account. Because it's one account, you can't say like, make this sub portion invest here, make this sub portion invest here. It's all one account. So for that reason, 401k administrators, most, if not all, you just have to allocate everything down the middle. Whatever you own evenly across your Roth, your after tax, your tax deferred. It is what it is. Again, maybe there's some that are different. I don't think so. I think this is a structural commonality across all 401ks, but maybe I'm wrong. But yeah, so you're kind of limited with being able to do this optimal location within your 401k, Mavis, and whoever the other poster was. Now, if and when you retire, or even if you work at an employer that allows you to do in-service distributions, maybe then you can get a little more control over it, right? You can sort of parse out some money here. So what's left in the 401, you can invest one way, and what you roll out, you can invest another way. But that might be like the cart driving the horse, or the tail wagging the dog. But good question / observation. And let me just see what other questions. # keep finance personal. Yeah, Cody Garrett. Personal finance is more personal than it is finance, and stuff like that. Canon, my risk profile says I should be 10% stock and 90% bonds cash, but my actual allocation is 85% stock and 50% bonds cash. Man, you are a cowboy, Canon. I'd be curious to know why. Interesting. Either your risk profile is like grossly understating your want and need for growth, or maybe not, or you're just really, I don't know, you're throwing caution to the wind and having a lot of fun with your stocks. So this is actually an interesting segue. So I think I mentioned in the beginning that, right, I did. So there's some cases, traditional logic is that, when you're in retirement or close to it, you need to ratchet down the riskiness of your portfolio, which generally speaking is true. But there's exceptions. So what if, for example, you're retired and you worked for a school district or a company that had a good pension, and you have Social Security and you live a fairly modest lifestyle? What if, and this is possible, I work with people that this is the case, Your pension and Social Security alone cover all of your anticipated expenses and then some, right? So, you're not tapping into your portfolio. You're retired and you're still saving extra cash every month because your pension and Social Security cover more than what you need. That's a great spot to be in. In that scenario, the investable assets you have at one extreme, you don't need them, right? Now, maybe you want to do a big vacation or otherwise have a big expense, and sure, that's what it's for. Or you want to leave it to your kids, great. But you don't need it to meet your living needs, your anticipated living needs for the rest of your life. With that in mind, you can go one of two ways. You can go super conservative with it and just plop it all in cash. So what if it doesn't grow because you don't need it, because you have a lifetime pension and income that covers everything and then some. So you can be super conservative, or go the opposite. You can go real nuts with the riskiness of it, because even if it does drop precipitously, drop by half or 60%, so what? You don't need it. It's not going to impact your life, right? If you're just saving it for your kids and your kids are decades younger than you and they're going to inherit it and they're going to own it for a long time, then yeah, maybe you do want to be real risky with it to grow, not for your sake, but for their sake, right? If it drops in value, so what? It's not going to harm you. And then everywhere in between. So in that scenario, there's no right answer. That's very personal. That's based on your emotional, philosophical views towards risk. It's much less financial at that point. Anyway, so maybe that's your scenario, Ken. And I don't know, I'm just making up words here, but that's one case where whether you're 10% stock or 90% stock, you could be fine either way, right? Anyway, so yes, interesting. All right, looks like that's it for the questions about tonight's topic. Let me now go back and look at the other random bag of stuff. Can you explain NUA? Yes, I could spend an hour on this. I'll try not to. I have a video on it, my YouTube channel. Go to YouTube and look up Retirement Planning Demystified. You'll see a video that touches on probably 80% of what you want or need to know about NUA. In a nutshell, it is when you have an employer plan, 401k, and you have employer stock in there. So they paid you, the match they gave you in the 401, they matched in the form of shares of company stock. NUA stands for net unrealized appreciation. Let's assume those shares they gifted you or gave you, or you bought yourself within your 401, they've increased a lot in value over time. Let me get rid of my screen share here now that we're done talking about this stuff. So those shares within your 401 have increased a lot in value from the time you got them or you bought them. What you can do is when you eventually leave, retire, whatever, and you empty your entire 401k, like you roll it into an IRA, you can split out the company shares, put them into a regular brokerage account as opposed to rolling them into an IRA. What's the pros and cons? Well, when you split them out and put them into a regular brokerage account, you have to pay tax in the year you do that, but you only pay tax on the original value of the shares. So let's assume the shares were 10 grand when you got them. They're worth $100,000 now inside your 401k. You can either roll all $100,000 of them into your IRA. When you eventually take that money out, you have to pay ordinary income tax on all of it, because all money that comes out of an IRA is taxed at ordinary income tax rates. If you instead roll those $10,000 in shares into a regular brokerage account, you have to pay tax on the $10,000 original value of the shares in the year you roll them. The other $90,000 of gain now you can eventually sell at long-term capital gains, which means it'll only be 0, 15, or 20%, as opposed to they'd be taxed at ordinary income tax rates if you took them out of your IRA. Make sense? I don't know if I laid that all out there cleanly, but basically that's it. It's the act of when you roll out your 401k, you split out your company shares, put them into a regular brokerage account, pay tax at the time on what your original cost was, and then you could eventually sell them later at long-term capital gains rates, as opposed to rolling them into your IRA and eventually being taxed as ordinary income on the distributions. Good question. Ooh, an IRS change question. Any new info from the IRS regarding the $10,200 in unemployment in regards to not being taxable? I already filed the return, and I hope I don't have to do an amended return. So yes and no. Well, I don't know when your last info is as of poster, but the IRS, it is official for people, whether you're married or single. if your adjusted gross income is below $150,000, or maybe up to whatever, it can't be over $150,000, let's say, you can exclude up to $10,200 of unemployment compensation that you received in 2020. You can exclude that from your taxable income. That's fact. If you already filed your return prior to this change and you already pay tax on this $10,200, then the IRS is saying as of now, you do not need to file an amended return. They are claiming they will do the work themselves proactively and mail you back a refund, assuming you're entitled to a refund. I don't want to say I don't trust that. I sort of personally rather would do the amendment myself. I know it's done. I know it's submitted, but I also don't want to go against what the IRS says and further complicate an already kind of messy, sloppy, potentially bungled situation. So I would do not. This is my opinion. Different people will tell you different things. What I'm doing with clients who I did taxes for, where this is an issue, we already filed the return. I'm not amending it. I'm waiting because the IRS has said, do not amend. We will take care of it for you. So that's the official line. If you want to amend, I don't know that it won't work. I don't know that it'll mess things up, but just caution, the IRS has said, do not amend. We will fix it for you. There's nothing you need to do. So do with that as you please. Technically, the IRS said, no, you do not have to amend. Good question. Okay. What else we got here? I didn't review this yet, but let's see what we got. My retirement plan is pension and a 457 for the most part. I was thinking upon retiring of transferring the 457 to an IRA, probably not Roth because I want to keep my income low. It will be a goal to play around with my income to take advantage of Affordable Care Act insurance and IRMA, which is the Medicare surcharge issue. Will I lose capability of monitoring income if I transfer to IRA and taxed as things happen in my portfolio rather than when I withdraw? Will I lose capability of monitoring income? No. So I think you have it backwards. So when things are in an IRA, you're not taxed as they happen. You can buy, you can sell, you can get dividends, you get interest. There's no tax at the time. You're only taxed when you withdraw money from an IRA. So it's the opposite of what you're saying here. So will you lose capability of monitoring income? No, because with an IRA, you have complete control over the income. You take out however much you want, when you need. You're taxed on it at the time. There's RMDs, required minimum distributions. When you hit 72, you have to take out at least a certain amount, but otherwise, you have complete control over your income from an IRA. So no, you don't lose capability. If anything, you have better capability in an IRA. And 457 is kind of the same thing, right? If you control when you take the money out, you're taxed on it when you take it out because it's a tax-deferred compensation plan. You should be well aware of the income and the taxability of it because you're controlling when you take it out. So hopefully that answered your question, poster. Oh man, no, I don't want to. Can you please explain in more detail the 20% reduction to REIT-related dividends? Thanks, Andy. Sort of. I don't remember the specific. Well, the high level is QBI stands for Qualified Business Income. And if you get income from qualified businesses, you can deduct up to 20% of that income. You can deduct from your taxes. Dividends, REITs are in essence considered businesses that you sort of own a share of a business, if you will. And therefore, any income that comes out of that business, i.e. dividends that the REIT pays, the tax code allows you to treat as if it's a business you own, and therefore up to 20% of that income can be deducted on your tax return. So that's what it is in a nutshell. Hopefully that helps. Now, there are limits and rules, like there's phase outs and stuff like that, where over a certain level of income, you start to lose how much can be deducted. And I do not remember those thresholds off the top of my head, but basically that's it, right? Consider a REIT sort of like you own a business, and you can deduct up to 20% of your income from businesses on your tax return. That's what this is, basically. Is this a question or a statement? Most of our savings is in 401k. Hubby retired in December 2020 and is 63 this year. I'll retire within a few years. What's the best strategy to move money from 401k to IRA to Roth IRA to minimize taxes? I know I need to be concerned with tax brackets and Medicare premiums. Yeah, deceptively easy, deceptively simple looking question. There's way too many moving parts behind the scenes and too many things to consider to say what the best way is. So I unfortunately can't even begin to give any real guidance on this, other than, generally speaking, the time periods you want to consider doing conversions and or just pulling money out of tax deferred accounts to spend is in one of two things. Either tax rates are lower now than they will be in the future, or your other sources of taxable income are lower now than they will be in the future. So you kind of have to look for years and opportunities where one or both of those things hold true. What we know objectively now is that current federal tax rates are historically low, too low. They have to go up. They will go up. That's fact. So we know tax rates now are lower than they will be in the future. But the other part of the equation is your taxable income. If you're working and still have high income, $200,000, let's say, that's pretty high. That's filling up a lot of your tax brackets already. So doing conversions on top of it may not be ideal for you. But let's assume you retire next year, for example. Your wages go away. Hubby's wages already stopped last year. So you may not have a lot of taxable income those years. Then those may be the right years for you to do some Roth conversions or otherwise pull money out of your tax deferred accounts, pay taxes on it while you're in those lower tax years and things like that. That's the general strategy. And that applies to anyone, right? That's the general guidance. Now there's more to that. Like I said, you need to factor in pensions you may have, Social Security, home equity, your expense needs, your spending needs, legacy plans. What do you want to do with your money? Do you want to give it to kids? Do you just want to spend it yourself and die with a penny left? Do you want to give it to charity? All these things matter, unfortunately. It also matters how much money you have in your traditional tax deferred accounts versus Roth versus taxable. So too many moving parts to say, but those are all the things that get baked into consideration of what to do and when with regards to getting money out of tax deferred accounts. And you hit the nail on the head with being concerned about tax brackets. You have to be aware of that. Obviously, the more you convert, the higher up the tax brackets you go. And Medicare premiums, right? The more you convert, the more you jack up your gross income, which starts to over a certain level, $88,000 for single, $176 for married. You start to need to worry about Medicare surcharges if you're 63 or older. Okay, good question. What do we got here? What else should you consider in terms of asset location for people planning to retire before age 59 and a half and will need to live off cash, taxable brokerage, perhaps portion? Right. Yeah. Whoever this is, thank you. This was something else I meant to bring into the equation. So you have to also look at your time horizon for your money, when you're going to need it. So let's assume the vast majority of your wealth is in a tax deferred account, which is fairly common, 401k or IRA or TSP or whatever. You have some money in a regular bank account and you have some money in a taxable brokerage account. You can't access the money from your IRA or 401k earlier than 59 and a half without a 10% penalty. Now there's some exceptions, but let's assume, they don't apply to you. So you can't tap that money without penalty. So you want to try to avoid it, which means your near-term cash needs are going to come from your bank account or your brokerage account. Now, if your brokerage account has $100,000, and let's assume that's all earmarked for you to live off of in the next 2 years, well, that now flies in the face of that chart I showed. And the more important priority here is if you need that money in the next few years, it probably shouldn't be invested much, if at all, in stocks, because stocks can drop and drop nastily, if nastily is even a word, can have a nasty drop in the course of 2 years. So you may not want that money at risk if you're going to need to take it out to meet living expenses, to buy a house, to whatever. So that then trumps what I showed before, right? In that case, matching up your asset your investment horizon with an appropriate asset type is more important than this asset location stuff, because you don't want to risk losing much, if any, of what's in your taxable brokerage account. So therefore, stocks are probably not the right thing in that equation. You're going to want to be conservative, like cash, or maybe some really low risk bond funds. So yes, that would definitely change the asset location. So thank you. Great comment. Oh man, here's a good one. How long do lower bond prices historically last? Pretend this is a crystal ball, Alan. I have no idea. Well, yeah, I mean, I should. Historically is what you're asking. It really all depends. It's a function of interest rates. If and when interest rates start to decrease, bond prices will start to rise again. Or bonds that you hold to maturity, their prices will have to go back up to par, to $100, because at maturity, you will get $100 when that bond matures. So that's why I'm saying if you hold individual bonds to maturity, the price changes along the way don't matter, because you'll ultimately get back that maturity amount of $100 or $1,000 face value per bond. But in bond funds, that's a different story, because bond funds, they often buy and sell bonds within the fund. So you do often potentially lock in gains and losses. So how long do they last? It really all depends. If interest rates continually rise, let's just assume worst case. I feel bad saying worst case, because it would be good for some inflation to come back, and means the economy is doing well typically. But let's just assume interest rates do a steady march upward for 10 years, Alan. Bond prices will continue, bond funds will continue to be, the prices will continue to be pressured a little bit. So it could last a long time. Again, not ideal, but bonds are what they are. They're there for stability and hopefully a little bit of income. They're not really there for long-term gains. Now, the last few decades have been a different story. Go back to the 70s and 80s when interest rates were like 20%, depending what rate you're talking about. There have been blips along the way, but for the most part, from 40 years ago till now, it's been kind of a steady downward trend of interest rates over time. And not coincidentally, bonds and bond funds have done really well over the last 40 years because interest rates have steadily declined and bond prices have steadily gone up. In my opinion, that's why places like PIMCO, you've probably heard of, PIMCO, the Pacific Investment Management Company, their total return bond fund was an absolute star for most of the last 40 years. And its lead manager, Bill Gross, was dubbed as like this oracle, this omniscient genius who whatever. I don't think that's the case. Not to knock the guy. I mean, he's objectively more successful than I'll probably ever be, but I think he just had not dumb luck, but he had a multi-decade long macroeconomic trend in his favor, i.e. interest rates steadily declined over the last 30, 40 years. If you invest in bonds and bond funds like he did, guess what? Those things go up in price when rates decline. It's that simple. Now, there's more to it than that. Yes, he did filter out and pick good bonds versus bad bonds, but generally speaking, he had Bill Gross and PIMCO and all bond funds over the last 40 years had a really strong tailwind thanks to decreasing interest rates. Now, interest rates are at or near rock bottom lows. They can't really go much lower. They can, but there's not a lot of room. The risk is kind of asymmetric. There's more risk. Rates can rise a lot going forward than rates can drop a lot. So I think bond funds are they got some headwinds going forward. Now, not to say you should disregard bond funds, they still play a very important role of providing stability and ballast against the riskiness of stocks, but you're probably not going to see impressive returns from bond funds for the foreseeable future, is my guess, Alan. Long answer, sorry, but hopefully that answered your question. G is a unicorn, cannot lose value. Yeah, I guess you're referring to the G fund in the TSP. Yeah, that's what I thought. So it's like a stable value fund. You're only going to get some positive amount of interest. It's not going to go to zero or below zero. Unicorn, good one. Oh, annuity question. I love these. Wow, it's 10 after 9. Can you discuss ideal location for an annuity asset if there's ever a good reason to have an annuity? Oh, come on, man. Yeah, no. Annuities are a 9-letter word. A-N-N-U-I. Annuities is 9 letters. Annuity is less than that. Anyway, yeah, annuity is often a 4-letter word, and many times rightfully so. But I've done and I will do again in the coming months, it's already on the schedule, one of these lives about annuities, just to break it down, discuss facts and fiction, and make sense of it. They're not all bad. They're actually really good, some of them, in the right circumstances. So if you have an annuity, that's what's called a deferred annuity. Deferred means you plump money into it, you plop money into it now. You can pick some sort of investments for that contract to be invested in, and then at some point down the road, you can either take your money out, or you can turn it into a traditional, you can annuitize it, have it turn into a stream of payments for the rest of your life. So what's the ideal location? That's a tough one. There's a few ways you can look at it, and man, I can go on for a while about this, but let me just leave it at this. So if you have an annuity where you bought it for some sort of what's called the income rider, you pay extra for this feature that in 10 years, no matter what happens to the market and your investments along the way, they're going to guarantee you some level of growth and some minimum amount of lifetime income from it. That's an income rider. If you have that, you can make a good argument that you can take a good amount of risk with the investments in that annuity, because you have this backstop. You're paying for it. This is partly why lots of annuities are expensive, because there's so many features and guarantees layered into it. They don't come for free. You have to pay for that, and rightfully so. So that's why annuities often have certain types of annuities have high fees, because you're paying for guarantees and backstops and features. You're getting something for the fee. Anyway, so if you have one of these income riders where you're guaranteed some level of growth at a minimum and some minimum amount of income, then yeah, maybe why not get risky with it? Because even if those assets drop, so what? You got this rider that's going to guarantee you some minimum something. Shoot for the stars, right? Maybe you can grow even more, such that the amount that you pull income from is higher than what your rider would have been. So that's just one argument, one case where you can go nuts with the risk in your annuity if that scenario applies to you. But otherwise, yes, you can choose to view it like a regular portion of your portfolio and invest accordingly in stocks or bonds or whatever, however you choose to allocate it or locate it. If you bought your annuity inside an IRA, that means it's going to be, it's tax deferred. Every dollar that comes out will be fully taxable. So consider that like a tax deferred account in that case. And in that scenario, lean towards the lower growth stuff. But again, it depends. If you have this rider, like I said, then maybe you want to shoot for the high growth, because why not? You already have this backstop, this minimum guarantee. Good question. I don't know what this is a follow-up to. Here's the rest of my question. Portions of Roth contributions only. Sorry, I don't know what question that was, original question I was referencing. So I'll move on. David Foltz, with respect to asset allocation, do you consider Social Security as part of one's bond allocation? Sort of not. I completely understand the rationale and the academia behind it. So Social Security is in effect an annuity. Sorry, I just wiped my nose here. And coming back to bond math, you can basically treat an annuity or a stream of income or a bond, you can put a lump sum kind of present day equivalent to it. So in that sense, you can take your assumed future Social Security payments, what's called present value it, treat it like a bond, and say, okay, my lifetime of Social Security is worth about $300,000 in today's dollars. I'm just making up a number. Could be more, could be less. And yes, there's an argument to be made that, sure, you can view that as a bond. I view it outside of that. And going back to my example before, Dave, where there's people who have Social Security and pension. Those are lifetime sources of income that are not going to stop. Now, yes, maybe the pension may implode and you get a little less because it gets kicked over to the national insurer, or Social Security might get reduced in some, worst case scenario. But worst case for people who are already on or close to Social Security, I'm saying, I don't think their payments will be reduced. Younger generation, yes, I'm fully assuming their payments will be reduced, but that's just my guess. Disregard that glitchiness on the screen. It'll go away soon. So I view them separate, Dave. I view, to me, retirement income planning is map out and project your anticipated expenses. Against that, match it up. Oh, that glitch. Match it up, pair it off with your sources of secure, stable lifetime income, of which there's only three: Social Security, pension, and or annuities. compare the two. You know, if you have enough to cover at least your basic minimum expenses, then great. If you have even more, even better. So pair it up, whatever's left, however much other expense you're going to have that's not met by these guaranteed sources of income. That's then how you decide, one of the main determinants of how you decide the allocation for the investable portion of your portfolio, right? Going back to my other example, if you have so much Social Security and pension that covers all of your anticipated expenses, Dave Fultz, then your allocation, frankly, doesn't really matter. And it sounds dumb to say that, and I can't believe the words came out of my mouth, but it really almost doesn't matter, because whether you quadruple that money or it goes to zero, it may not impact your life much, if at all, if you have this pension and Social Security that'll last forever and that will cover, you know, all of your expenses. So I view it separate, but some people do treat it like a bond and lump it in. I don't see anything wrong with that. It's not the way I choose to view it, Dave. Unicorn rainbow, that's even better. I like that. All right, I'm going to take a few more here. My voice is getting horsey. My lips are getting chapped. I have access to a 403B that guarantees 3%. Damn. We can roll over additional money from IRAs. What percent of our investable assets should be? Oh, man, I can't touch this one. This is way too specific. Sorry. This is actionable, tangible advice you're asking of me. And I appreciate the question, but that's too specific to you and your circumstances. It's hard to say. You kind of figure out, yes, I mean, it would make sense. You can use that as a place to keep your cash, because 3% is much better than the 0.5% you get from a savings account. But here's what you have to keep in mind. This is a downside with using a stable value fund in a tax-deferred retirement plan, is that all that money that comes out is going to be taxable. So you don't necessarily want all your cash in there, because if and when you take it out, like let's say you have some big emergency, your furnace blows up, you need a new car, and put on top of that something else. I don't know, one of your kids or something needs 30 grand from you. You don't want to be in a position where you're forced to pull out 100 grand in cash unexpectedly from a fully taxable account like a 403B. That may spike your taxable income a lot, and then that may have, in addition to higher tax, it may make you subject to the Medicare premiums. Possibly the net investment income tax, which I did a video on a week or two ago, things like that. So it's hard to use a stable value fund in a tax deferred world as your primary source of cash. But yes, there's definitely logic to having some there. Now, there's a question someone posted in the group. Can I treat my stable value fund as my bonds? Because there was paying whatever it was, 2.5% interest, I want to say. And my answer is sort of like, yes, that going back to my example last year, the bond fund I typically use is an intermediate term bond fund, meaning the bonds in it mature in like 5 to 10 years on average. That fund did really well last year because coincidentally interest rates dropped. So that fund got, I think I wanted like 8%, give or take a percent, if I remember correctly. That's really good, right? Stable value funds would have gotten 2.5%, 3% last year. In that case, the bond fund did much better. Now, the flip side is what's happening this year. The bond fund I typically use is down like 3% for the year versus your stable value fund is up 3%. So can you, are you leaving money on the table? Perhaps, by only getting 3%. I feel bad saying only getting 3%, but that's the choice you have to make, right? A good bond fund isn't going to be wildly risky. It's not going to drop 20%. If it is, your manager or whoever picked it is messed up. A good bond fund should churn you a little bit of interest. 1.5% now is probably the going rate. And the price is going to go up or go down a little bit. So it's going to bumble near flat-ish, hopefully make money more years than it loses money. So I don't know. Can you? Yeah, you can use the stable value as a portion of your bond fund. I don't think I go so far as to say dump all of your bond allocation into stable value, because chances are you can probably, do better over the long term with a bond fund than stable value. But that's, anything could happen. I'm just saying, historically speaking, at least, maybe a bond fund will do better. Yeah. Anyway, so not a great answer, but it kind of really all depends, and there's no sort of single answer to that. Whoever posted that, Mavis would welcome a nerdy session on bonds sometime in the future. Yes, I taught analysis of fixed income for 2 semesters at the MBA program at Rutgers Business School. That was some nerdy stuff, teaching bond math and convexity and duration. I may pull some of those charts and spreadsheets out for those of you who are interested. That's going to be some wildly fun times. Okay, where are we at? What else do we have? Just seeing what other questions we have. Same. Okay. What is this? Other than using RMDs as qualified charitable distributions, is there any reason why not to convert everything possible to Roth? I've just seen widows get hit pretty hard after becoming single filers. Yes, there's a few things here. Again, it depends. There's a lot of potential moving parts to this. Converting everything may be overdoing it. Only time will tell what the right answer was, but converting everything may be overdoing it. Unless, if you have a large pension, like there's some people who have 6-figure pensions, that money's never going away, right? They're never going to be in a low tax bracket in retirement because they're always going to have at least that pension. If you have Social Security on top of it, that's even more money. So yes, in that case, you're never going to be in a low tax bracket in retirement, right? So maybe then it starts to make some more sense to potentially convert all, but even then, converting all, that feels like overdoing it. Because there can still be times in the future, like doing qualified charitable distributions, or like if you don't have massive pension, you can still pull some money out in the future in relatively low tax brackets. What else? If you potentially have a long-term care event or other years of large medical expenses, you can have lots of deductions in those years because of those expenses. And those would be good years to have, a decent sized pot of tax deferred money to pull out, because you'll have large deductions to help offset it. So there are defensible reasons why you may not want to convert everything. But I do know some people who do, whether it's because they just want the surety of knowing it's all done and out of the way now. Some people think taxes are going to double or triple in the future, in which case, yeah, then maybe you want to convert aggressively. But it really all depends. Good comment, though. Does the unemployment exclusion go for dependents also? Ooh, I don't know. It definitely spouses. If you're married and both spouses had unemployment, yes. For dependents on your return, I honestly don't know. That's a good question. Good one. Do brokerages discount the REIT 20%, or do I manually adjust them on my taxes? When you get to 1099 at the end of the year from your brokerage account, it'll have on there, I think it's line 5, I could be wrong, line 5 or 11 maybe, of the 1099 div for dividend. It'll say, what's it say? I think it says 199A dividends, and those are the QBI exclusion deduction. That'll be your REIT. So no, you don't have to do anything. Just take that, plug it into your tax return software. It'll do the calculation for you. Okay, I'm running out of steam here. Let me just selectively pick. Sorry for those I'm skipping over, but does an average investor have access to individual bonds? Yes, but it's probably not going to be cheap. So bonds have a minimum denomination. Sometimes it's $1,000, sometimes it's 10,000, maybe it's 500, depends on the bond, $500. But yes, there's a minimum denomination. Treasury bonds, you can buy direct from the U.S. government, treasurydirect.gov. You can go to buy treasury bonds. But if you want to buy a corporate bond, your municipal bond direct, you have to go through a broker. There's going to be a commission. I frankly don't play around with individual bonds. So I don't know what commissions are. I probably check on TD, but don't be surprised if it's $30 to $50 per trade to buy a bond through a broker, Alan. But yes, you do have access to them with low minimums. No, it depends on the bond. Some bonds, like some treasury bonds, minimum denomination is $10,000. Corporate bonds, oftentimes it's only like $1,000 or something. So it depends. Where would I hold TIPS, which are treasury inflation protected securities? Yeah, they're same as other bonds. They're government backed bonds that pay interest. The difference is the interest is keyed off of inflation, but yes, they're functionally just another bond fund. All right, looks like we're getting to the end here. what is the best asset type for inherited traditional IRA with attention to RMDs? You have to, good question, Teresa. You have to look at it in the context of the rest of your portfolio. So like I work with some clients I have inherited IRAs. And what we're doing is we are part of the income distribution plan we're setting up is what accounts take money from, when, and why. For a couple clients I'm thinking of, we already emptied an inherited IRA this year. The other client, we're going to be doing it this year, if not next year. And for a few reasons, partly because there's RMDs on it. These clients are younger than their own RMD age of 72. They're only in their 60s. So they're still plenty of years away from having to tap their own money. But these inherited accounts, in both cases, they inherited years ago before the Secure Act changes. So you have to take it out over, within 10 years. So they've already been having to take RMDs from it. Knowing that our plan is that they're going to be emptying these accounts sooner rather than later, we have the accounts invested in just bonds and cash, flat, safe, stable stuff. They're not going to make a lot, but they're not going to lose a lot. Therefore, we know we're pulling out 40 grand this year, let's say. We don't want that 40 grand to go up to, to drop to 20 grand. And it'd be nice if it went up, but we don't want to take the risk. So this is an example of, like I said before, where the what wins out here is not the asset location per se, but the matching your time horizon with the investment. The time horizon here is we know we're emptying these accounts in a year or two, so we want it to be fairly stable investments, not a lot of risk of loss. Hence, we're using bond funds. And just coincidentally, bond funds, like I said before, are good to have in tax-deferred accounts because they're not going to have this like runaway growth like stocks potentially may. You want the high growth stuff to be in Roth accounts or traditional taxable accounts where they'll be taxed more favorably than if all that growth is in a tax-deferred account like an IRA or an inherited IRA. Good question. Okay, that is it. Yeah, that's it. So I'm done. All right. Well, thank you all. Hopefully you found this helpful. I will see you again next week. I do not recall what the topic was. I just look while I'm here. Next week is what? March 31st. Pros and cons of rolling over employer retirement plans into IRAs. That's going to be a juicy one. People always ask about that. So anyway, hope to see you next week. Until then, I will see you in the group and have a good week. Good night.